For me, trading options and specifically selling covered calls throughout my portfolio over the past several years of my investing career has completely changed everything for my investing outlook and has truly allowed me to earn so much extra money from the stocks and ETFs I already own in my portfolio. Now, I understand you probably clicked on this video because you want to start selling covered calls, but you're not necessarily sure or aware of what a covered call even is, how it works, or specifically, maybe you just don't understand how to sell a covered call on the Robinhood platform. Well, I have good news for you because in this video, we're going to go over exactly what a covered call is, and I'm going to share exactly how covered calls work. Then later on in the video, we're going to sell a covered call right here on the Robinhood platform, and I'm going to walk you through step by step on exactly how you can also do the same. So if you want to learn about covered calls and see exactly how to sell one on the Robinhood platform, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So first off, before we head back over to Robinhood and I show you exactly how to sell a covered call, I go over all the numbers and everything, take you step by step, going over some of the key takeaways when it comes to a covered call. This is right here on Investopedia. It says a covered call is a popular option strategy used to generate income in the form of options premium. So this is one of the main reasons why I got so interested in selling covered calls years ago, is because I personally run and have been building a long-term dividend growth portfolio, which pays me income ongoingly on the monthly and quarterly basis. But in the portfolio, I learned that there was a way where I could generate even more income in the form of selling covered calls by earning option premium. Now, it then says investors only expect a minor increase or decrease in the underlying stock price for the life of the option when they execute a covered call. To execute a covered call, an investor holding a long position in an asset then writes or sells call options on the same asset. Covered calls are often employed by those who intend to hold the underlying stock for a long time, so good for long-term investors, but don't expect the price to really move up or down necessarily too much in the future, or for covered calls' sake, you'd rather even it move down a little bit. This strategy is ideal for investors who believe the underlying price will not move much over the near term, or like I said, maybe even down a little bit, which would be ideal for call sellers. Now, of course, I can make this video an hour long. We could go over and define every single thing there is when it comes to trading options, when it comes to buying calls, selling calls, and everything else. But just to get right into it, I'm going to go through all the basics, get you up to speed just to understand the basics, everything you need to sell your first covered call. So right here on the Robinhood platform, keep in mind you can sell calls, buy calls, you can trade options on pretty much any brokerage as far as I'm aware of. But right here on the Robinhood platform, you type in any stock that you want. For this example, I typed in SoFi, which is a stock currently trading at around $6.65. You would then click on the side, trade options, and it would bring you into this page. Now, just as a side note, you will have to actually get an approved account to be able to trade options. I think you basically just contact Robinhood. It takes like a day or so. I did it so long ago, I can't really remember, but it's very, very simple. And then as far as I know, it's free to do. So once you're on this page, you can see right here, we have buy, we have sell, we have call, we have put. So of course you can buy calls, you can buy puts, but for this video's example, like I said, we're gonna be talking about selling a covered call, which is going to be on the holdings that you already own. So another side note, when you are selling options, you are always going to be selling options in groups or lots of 100. So if you don't own 100 shares of something, you can't sell a covered call on it. So this is assuming that for this video's example, you purchased 100 shares of SoFi stock, let's just say at $6.65 per share. So $665 invested into SoFi stock, you now own 100 shares, which means at this point you can trade options because options are always in single contracts. One contract equals 100 shares. That's very important to know, but also very easy to remember. 100 shares equals one contract. So for this video's example, like we said, we're going to be selling one contract, one covered call on our SoFi stock. Right here you can see it says expiring today, and there's different dates throughout this entire drop down. This is going to be the date where the contract expires between the buyer and the seller. Now you guessed it, during this example, we are going to be the seller of the contract. There's also going to be a buyer side. But for this example, we are going to be specifically the seller side. Now you might be asking, well, which one of these do I pick? How far out do I really sell my covered call? Do I sell it for a short duration, like a week, or do I sell it for a long duration, like all the way till 2026, which is 685 days away? Well, that's going to completely depend on what you think is going to happen with whatever stock or ETF you're selling your call options on. But for this video's example, we're going to be selling a long call option, which is going to allow an investor to receive a massive amount of premium because the contract has so many days ahead. If you sell a call option that has a shorter duration, you guessed it, you aren't necessarily going to earn as much premium because there's less time, there's less chances of things happening in between. So generally speaking, the longer out that you sell an option, the larger the premium is going to be, which means on the buyer side, they're going to have to pay more to buy this contract from you, which means at the seller side, you're going to earn more premium, which is awesome. Now there's also different instances like earnings report. Let's say that one of these durations have an earnings right next to it. Well, then maybe the premium might be a little bit higher because volatility will be spiked during a SoFi earnings call. And there's other factors to keep in mind. But again, for a very basic overview, this is the different expiration dates. And for this video's example, we're going to be selling a very long duration, 685-day option contract, which is going to earn an investor that's selling the call a massive amount of premium, and which also means the call buyer is going to have to pay a pretty penny for this. So now that we understand that we're going to be selling a call, we have the expiration date 685 days away because again, we're choosing a very, very long duration call to sell here to earn a ton of premium. The next thing that we're going to look at is right here, the different strike prices. Now the strike price is basically the option contract's price that you're willing to sell off your shares of SoFi at for this example. Now, like we said, for this example, let's say we bought SoFi 100 shares of it for $6.65 per share. Now, because we bought it at that price, we're going to have to choose our strike price that we're willing to sell our SoFi shares to the call buyer to. So for example, on or before this expiration date, if you're willing to sell your SoFi shares for $7 per share to the call buyer, you're going to receive $2.32 of premium from the call buyer for every single share you have, or $232 to be exact because you just times everything by 100. So that means that your break-even point is going to be $9.32 as the call seller, which means as long as SoFi stays below $9.32 on or before this expiration date, you are going to be profiting whatever the delta is. Now for the call buyer, this means that if they purchase this call option for $2.32 per share, or $232 to be exact, SoFi would need to go up above $9.32 per share because of course they also still have to buy your shares for $7 per share, which means SoFi would have to go up to $9.33 until they would make a penny of profit per share. So this is why I said earlier that call option sellers are hoping that the stock trades mostly sideways up a little bit or even down a little bit, because again, you're basically locking in a sale price in the future on or before the expiration date, and you're getting paid the premium for doing so. Now, another thing to note is right when you sell the call option, you get the premium right away. That was one of my biggest questions early on. For selling call options, I always wondered, well, when do I get this premium? Do I have to wait until expiration date? So to answer your question, the minute that you sell these call options, at least as far as I know and all the brokerages I've used, you receive the option premium right away as the call seller because the call buyer basically just paid you to lock in that option contract. You guys shook hands and both went on your way. Now let's look at some other different strike prices. Let's say that you don't want to sell your shares of SoFi for $7 on or before this expiration date. Let's say you want to get some more profit out of it. Let's say you're willing to sell your shares of SoFi on or before this expiration date for $10 per share. Remember, you bought SoFi for $6.65. So this is saying that you're willing to sell them for $10 per share, which is a nice little profit, especially during this duration. Well, even by selling them for $10 per share, you're still going to get paid $1.61 for doing so. And as you can imagine, the higher up that you go as far as strike prices go, the lower amount of premium you're going to receive, and the lower strike prices you go, the higher premium you're going to receive. Because again, it's all based upon probability. What's going to happen in the future with the share price, and who's going to get the better side of the deal? Is it going to be the call buyer or the call seller? Obviously, as the call seller, you're hoping that you do. So to make it simple enough, let's say as of right now, once again, you bought SoFi for $6.65 per share, and you're willing to sell it in the future for $7 per share, just a little bit more than you bought it for because you're not greedy, you just want a small little profit. Well, by doing so, you would once again click on this right here, and you would sell that contract for $2.32 per share, so you would earn $232 just for allowing the call buyer to have the option to purchase your shares for $7 in the future, no matter what happens from there. Now, the upside is, let's say SoFi trades sideways, down a little bit, up a little bit over this time frame. Well, of course, you still own your shares, you retain your shares, and you earn the premium, of course. But on the other hand, let's say SoFi moves up to $14, $20. Let's say something crazy happens and SoFi moves up to $1 million per share. Well, in that point, you would still be locked in a contract to sell your shares of SoFi for, you guessed it, $7 per share on the spot. No matter what happens during that time frame, the call buyer still has the option to buy your shares for $7 per share, regardless if it goes up $1 or $1 million, they still have control. So the way that I sell call options in my portfolio, different positions that I have hundreds of shares of, I would probably go up a little bit further away from where I bought it from, sell some call options, earn some premium, and make it a very, very low chance of my shares actually getting called away, or make it a small chance of the call buyer actually using the contract and purchasing my shares for whatever strike price we agree upon. And by doing so, you can basically earn a ton of premium and still own your shares, basically have the best of both worlds by doing so. Now, of course, different stocks and ETFs that might move around a little bit faster, have a little bit higher beta, are going to have a different level of risk when buying options or selling options, but that gives you a basic overview on exactly how to sell options on the Robinhood platform and should give you everything you need to sell your very first option today. So now that we've been over exactly how to sell your first call option on the Robinhood platform, I now want to hear from you guys down below. What is the very first stock or ETF you're planning on selling your very first covered call on? Drop the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.